Got it. All right. Doors are open at 11:58. This is good. Ah, Jolene, no hail or anything in Colorado. We're all good.
Kim? I'm Kim.
I'm
But
sorry. Sorry. I was
that's
thinking
okay.
Jolene because of the move. Sorry.
Yep. No hail. It's sunny today, so
Nice.
that's good. Hmm.
Nice. It has been overcast here in Chicago pretty much all day. Same up north and up north, Lori.
No, the sun is shining. It's
Oh, really?
beautiful.
We
Yeah.
have not seen the sun in the suburbs all morning. So not here, that's for sure. All right, I gotta open the chat up here. Okay, good. All right, doors are open. It's 11:59. We'll let everybody get in and then get everything going. So that's good. Enjoying my Jimmy John's. So did they find you, Kim? Did they find you or are you waiting?
Yep, it's coming. So thank you,
Okay,
Tony.
good.
Yep.
That's good. That's good. Uh there you go. Was sunny in Elk Grove earlier. Yeah, I don't remember the sun being out here that much in Rolling Meadows. So sunny in Des Plaines, according to Frank. Oh, he's sending it my way. You're the best, Frank. Appreciate that a ton. So appreciate that. All right, we are at 12 o'clock. Thanks, Heather. Gorgeous day in Elgin. Why is it just cloudy here? But that's probably a good thing because you guys wouldn't be able to see me. It's already bright enough back there. All right. So we do love this session, and we are going to get kicked off with a couple things that we want to work on here. So welcome. This is our monthly lunch and learn. And as you guys know, we try to bring value. And I'm excited actually to hear from our sponsor today because she has very valuable information to provide you guys about some things that are coming up as it relates to your clients' homes. And let's face it, the homes you guys live in as well, because it's going to impact that as well. Anybody that owns a home, some of the things Lori's going to talk about in a little bit will help. Now, for communication, before I get too deep into that, if you are expecting a Jimmy John's order and it hasn't been received, please email Tony. She has her email in the chat, or she will. If you got any issues with that, please do that. Also, if you're in a brokerage office and you've got a bunch of people watching, let us know how many people are watching. That does help for our head counts. We like to know who else is watching, as some of the brokerages out there do put this in their conference room. So that's also helpful for us to know. Do some quick introductions here. Well, we're going to start with Lori because Lori's got some really good stuff for us. So those of you who don't know Lori, don't get out to events because she's at every event that I go to. So, but Lori has been in the home warranty space since 2007 and with Choice Home Warranties for the last 5 years. Her and I talked about, usually we have a little 3-minute commercial about home warranty, but she has more of a PSA for you guys about what's coming up on some functional mechanicals within your property and how Choice can help. So without further ado, Lori, who paid for a lot of our sandwiches, we appreciate you and fire away.
Thanks, Rich. I appreciate it. Great to see everybody here. So yes, as Rich was talking about, who here has an air conditioning unit at their home? Probably all of us, right? Um, so in January of this year, so January of 2025, the EPA mandated that the older units with the R22 and R410A refrigerant, the parts could no longer be manufactured. So it's already starting to happen in our area where somebody's unit goes out and it just needs a $50 part and we can't get the parts for it. So it's going to be even more prevalent next year, but it's also going to affect furnaces as well. So if you have a unit or you have a client, you have a buyer, a seller, anybody with an air conditioning unit that has one of the old refrigerants in it, which is probably 90% of the air conditioning units out there, parts are no longer going to be available. So the Freon is already running out as well. But the good news is that Choice Home Warranty, our ultimate plan, is going to cover for the compatibility between the old and the new units. So over this summer, to replace an air conditioning unit retail cost, it was around $8,000. So I can only imagine that next year it's going to be even worse. So it's just vital that every single person who owns a home now have a home warranty to help alleviate those costs. There's still going to be some out-of-pocket cost to the homeowner, but it's going to be, a couple thousand instead of 8 or 10,000. So it's happening now. It's happening to anybody that has an air conditioning unit. So I would love to send you some more information on it. I have flyers, I have videos. I can come into your office and do, a presentation to your agents if you want me to. But it's going to affect all of us.
Lori, one quick thing about that too is because we talked about it yesterday in our practice session for this, and if you guys are looking for a reason to reach out to your closed clients, this is the perfect reason. And she's got a ton of marketing materials around this. And in fact, as small of a group that we had yesterday in our practice session, meaning the four of us on the screen here, Tony, they've just replaced some of their equipment, and not only was the equipment, obviously the equipment was new, but a lot of the lines had to be replaced because they no longer are suitable for the new refrigerant that's out there. So hopefully I said that right, not being an HVAC guy, but yeah. So I mean, the bottom line is this is something that you want to reach out to Lori, use it as a leverage point to have some conversations with your client, PSA, provide them great information. If their furnace slash central layers are borderline, they may want to reach out and talk to Lori. So Lori, thank you so much. If anybody has any questions about that, please fire those into the chat. We do appreciate that. We've got a couple of announcements too that we're going to do at the end of this call. So a couple offers that we've got, plus a kind of a last minute little live webinar training we're going to do introduce at the end. So definitely stick around, but we got to get right to Kim. She is busy today. Kim is one of our regional underwriting managers. I probably butchered that title, but that's what I consider you. So regional underwriting manager. So Kim has been in the underwriting space since 1997. And I consider her definitely a wealth of knowledge. And she's given her time, as she's done in the past, to help answer your questions, which you guys can enter in the chat. But we're fortunate we got some questions ahead of time that we're going to be talking about with that. Now, Kim does underwrite in what we call our agency loans. And in short, what that really means in English is FHA, VA, Freddie Mac, Fannie Mae. There's other loan products out there that we can kind of talk about a little bit, but that's not an area that she oversees. So we may end up deferring, but I doubt it. I think there's enough knowledge between her and I that we can handle most of the questions that are going to come. So that being said, Kim, did you want to introduce yourself or anything else that I didn't already add?
Yeah, you bet. I just, hello, everybody. I know I've talked to some of you before on other calls, so thank you, Rich and Tony, for having me join. I've been with CrossCountry for 7 years, and as we know, these underwriting and lending guidelines and requirements change all the time. So I do pride myself in taking heed to all of them as they update and change, sometimes on a daily basis, right? Since COVID happened, it feels like it's consistently changing. So glad to answer any of your questions and excited to talk to you guys. Thanks, Rich.
Thank you, Kim. And I got to tell you, one of the reasons I've been with the company close to 14 years, one of the reasons that we've grown as quickly and as largely as we have is underwriting. We have excellent underwriting with phenomenal turn times. We were on this morning with the owner of the company who was talking about doing certain refinance underwriting turn times in 4 hours with the goal of being at an hour for any of those refinance turn times. So yeah, kind of fun. But we're going to get right into this. And again, keep the chat open for any questions. First one is probably for both of us, Kim. But Joe asks, what can realtors do to pre-qualify their prospects? And this one, I don't know, you want to handle that? You want me to handle that?
I mean, I'll say it right away. Contact your LO as soon as possible. That's the main thing because there are so many changes like we talked about, and LOs are abreast of every situation. And as long as they get the clarifying answers, they can find a program. I'll let you take it from there.
I mean, I think there's no way for a realtor to know just the wide breadth of programs that are available. It's insane with what just keeps coming out. I mean, we've got programs for people without income. We've got programs where we can verify based on bank statement activity. We've got programs where we can qualify somebody just based purely on the rental income on the property they're buying. So, I would tell you, and then if it's a credit related item, I mean, cross country on an FHA loan will go down to 500, keeping in mind anything below 580 requires at least 10% down. So my advice really there, Joe, is that don't try to be the loan officer, get it to your loan officer as quickly as possible. All right. Let's see. Jeanette asks, let's see, Kim, a buyer using conventional financing agrees to the condition of the home. Let's say it sounds like maybe as is. So agrees to the condition of the home. What potential issues might an underwriter still flag on a conventional appraisal, example, cracked window?
I love this question. I love appraisals because I feel like that is definitely what we're lending on, right? Our risk is definitely the borrower, but we are lending on the property, the collateral of the loan. I like looking at appraisals. Conventional appraisals have less mandates or requirements that need to be done on the property or that the property needs to meet. As you get into the government loans, they are bigger requirements. They're a little bit harder on the collateral to make sure that it meets their minimum property standards. So the reason for this is that the lender or the investor or the agency is trying to cover themselves in the event that the risk of the loan, the borrower, forfeits or forecloses on, that we still have collateral that we can definitely use to make up the loan, the amount that we lend it out. So, uh, what does happen and what is great about CrossCountry is we allow escrow holdbacks. So if there is a cracked window that maybe the seller doesn't have funds to pay for at the time of closing, we can do an escrow holdback. We'll hold back the amount of a bid for a cracked window and then from the seller's funds. And then once we have evidence that that cracked window is taken care of, we will release those funds to the seller. So that's something that a lot of other lenders have issue with or won't allow, but our agencies will. If there is a major problem with it, with the property, i.e. a roof or foundation, that's something that we really need to dig into and see if we do any of our reno loans or something of that nature. Hopefully that helps. That is the main reason why underwriters definitely do look at the collateral to make sure that it is meeting minimum standards.
No, I think that's a perfect answer. And I know we are one of the few companies that not only will we do a repair escrow, but we're the ones that actually hold the funds. We don't really punt that off to the title company, which allows us to keep the cost down because the title company is going to charge us another $150 to $250 to manage that aspect. So that's a good thing. And yeah, I mean, we're in it to close loans. Now, one of the other things that I will tell you guys that you may see out there as it relates to a property, a buyer accepting the property as is, one of the things that we do not require is a seller's disclosure. So now that's none of the agencies specifically require a seller's disclosure. So Fannie Mae, Freddie Mac, FHA, VA, we have a seller's disclosure here in the state of Illinois. If you're providing that to your lender, and there's something checked off in there, then yes, your underwriter is going to say, hey, you guys checked that there's foundation issues. We need to do a further dive. I personally would recommend you don't ever provide that if you can avoid it. However, there are some lenders that require that seller's disclosure be advised. And the last thing, as a piece of advice for agents, I've had situations where I've heard a lender asked, "Hey, can you send us the home inspection so we could, maybe use that to determine that the foundation was okay?" Well, you send a home inspection or a home inspection to an underwriter, you've just asked for the underwriter to ask a lot more questions. So don't send the home inspection. There's definitely better ways to handle that situation. So, all right. Anything else
Before you move
go
on,
ahead,
Rich, there's
Kim.
a couple of questions, and I wanted to point out from Angela. Ellen asked, how would we write something like that up? Definitely in the purchase contract, you can put that there's an escrow holdback or there's a request for an escrow holdback to fix blank based off of bids. And that's just to let the underwriter know that that's what's coming in. We also, if number one, the appraisal has to be subject to. If the appraisal isn't subject to and the appraiser does not want to do it, but it's something that your buyer wants completed, then it does need to be on the purchase contract. So that's a great question, Angela. Thank you so much for asking that. And then the next question was, usually the appraiser asks for the seller disclosure. Ugh, I hate that, and I know that they do. But that leads right back into, we do not ask for anything unless the appraiser addresses it, right? Unless it's a guideline on a government loan or something that we think may be an issue. We don't ask for it. The appraiser is the one who determines the property and the condition of the property and what we can and can't do. They know the guidelines. Are there discrepancies sometimes where an appraiser thinks that it's okay and we don't? We usually get those resolved in-house, right? But uh, I don't know what to say when an appraiser asks for the seller disclosure, but I would also say, they're trying to get a basis, and I would not send that to them if I were you. That's it.
And I don't believe RAMC, no, it's perfect, Kim. Thank you. I don't believe RAMC mandates that either. So it is a call that I'll put up to our appraisal management company just to make sure if you guys are getting a request from one of our appraisers that's asking for that, I ask you to reach out to me and I will make sure that we get that cleared up. So I don't think that's a necessary document and eventually it can slow down your closing, which we don't want to do. So let's see here. Lydia says the seller's disclosure you're talking about is the required real property disclosure. That is correct. Yeah, that is correct. We don't need that. None of the agencies require that. Now, that doesn't mean that there's lenders out there. Chase, for example, I know they want that as part and parcel of what they do. And we may sell to a lender that's going to ask that. So that will happen on a rare occasion that we would sell to a lender that would ask that. But I would say a 99% of ours, we're not going to need it. So, but great questions in the chat. We appreciate that. Oh, this is a good one, Kim. So Monica wants to know, I am interested in understanding the underwriting process, everything you've learned in the last 28 years. What is important to them, the do's and the don'ts?
It's very hard, right? I think that when the process is definitely about the flow, we talk about the looking at the 4 or 5 C's, right? Credit, collateral, cash, and capacity. There's another one that's capital, but I'm going to put that one off to the side. But definitely we need to make sure that the credit is good for our borrower. We need to make sure that they have the cash to close. The capacity that they have the ability to make the repayment of the loan. And then I think I skipped collateral, which we talked about a little bit before. So the flow of that's the main thing. Guidelines change all the time. So I can't tell you exactly what is good and what is bad and what is allowed and what is not. But what it is definitely, if you have somebody who has major delinquencies on their credit, that's something that we take a look at to make sure that we can fit them into a program that allows those delinquencies. If we have somebody who is starting a new job, is this a stable job, right? They need the ability to repay. So very important do's and don'ts that we tell the borrowers, and Rich, this is for you to take over as well, but I would say the ones that hurt loans more than anything else are borrowers who go and get a new loan. either for a car, or they get a new credit card, or they decide that they need that furniture, so they get that installment agreement from in the furniture store. Those are the bad things that happen. That also includes this brand new thing that started in the last 5 years or since COVID, Affirm, Klarna, all of those fun little things that say, buy this now and you can pay later. As underwriters, we have to hit them for those payments. And those can be very detrimental. The $25 still seems like, oh, it's not a big deal. But sometimes we are using that $25 and it can make or break a deal for sure. So
Affirm,
I'll let you
Affirm,
take it from there. Yeah.
yeah, sorry, Kim, but yeah, Firm has really been popping up lately, and I know there was I heard last week there's some discussion to maybe start getting those on credit reports. So, where that filters into the mortgage credit report world, I don't know, but I look at this question and I go, is Monica asking, what can we as an agent do to better understand the program? And I think, with everything with the borrower, it's making sure that when you are talking to your buyer, make sure that your buyer has to understand that the lender can only move as fast as the buyer does. Like I can't physically go into their computer and print bank statements and ship them off. Like, so there's only certain things that we can do. So if there's something you want to do to assist an underwriter in the long run, it's making sure that your buyer provides documents required by the lender as soon as possible. So we can get them in front of an underwriter as soon as possible. So, or processor slash underwriter. This way, if there's anything within those documents that becomes a problem, we'll know it ahead of time and we can get on top of it and address it. So having that documentation earlier than later is always helpful. And one last thing, just relative to the underwriting piece, and I think Kim will get a kick out of this. I can't tell you how many times, and this sometimes comes from agents, they'll say, okay, Rich, I know you've been waiting for that document for 3.5 weeks. I'm emailing you the document now. Can I close tomorrow morning at 9? Well, that's not the process. The process is the document comes in to me, it gets sent to a processor who then reviews the document thoroughly to make sure it's not going to create any other questions. Then that document gets sent to an underwriter who then review that. Now, to that buyer that waited 3.5 weeks, nobody was sitting on their thumbs just waiting for the document. They have other files and other things that are going on. So it's not an instantaneous type thing. Once the document comes in, we close in the next hour. So understand that it's got to go through normal processes. Now, can I call the processor and say, I'm sending you the document, send it to Kim? Yes. And could she call Kim and say, hey, I'm sending you the document, can you send it in? That can happen. But again, that's not the process as it stands. So, all right. Let's see here. Let's see. I wish I had Jim. I wish I had my buddy Jim Drusky in here for this. Is it possible for prospects or clients to do a rapid rescore on their own? So I should ask Jim that question. I'm not sure. I'm not sure about doing it on their own. I know we can do it for them on our own credit reports. Oh, actually, it probably wouldn't be because we have to go to our bureaus and have them do that and kind of force that into the bureau. I'm not sure that they can. It's a good question. I'll have to ask Jim. You don't know that answer, do you, Kim?
I do not. I don't, I do know that on borrower's behalf, they can definitely work with the credit agencies, but the final documentation has to be where we receive it from the third party, not receiving it from the borrower.
Yeah, I'll double check on that with Jim Drusky with Illinois Credit Services. That's our guy that we've referred to in the past. I'll get you an answer on that. All right, next question. Let's see here. Should clients pay off closed accounts before applying for a loan or when advised by a mortgage professional? I'm not sure what closed accounts. I'm thinking there may be charge-offs. So I'll leave you with that question.
So, if there is a collection, and it is reporting that it just recently went into a collection, then that's where it does affect our uh, current review of their credit capacity. If it is older and it's medical, that's where we can disregard those collections. If it is a charge off and it's older and there's no um, uh, collection efforts being made, then that's something that we can also disregard. So I think that we don't really ever tell them to pay off loans, unless it is required for maybe their debt to income ratio. If they have the capacity to do that, if they have additional assets that can cover that, or, if they can get a gift, just to get an approval, for their debt to income ratios. But, uh, we don't, I don't really know if you guys tell them to close things or pay them off before they come to us. That could happen, but, uh, do you have anything else to add to that, Rich? I'm sorry.
Oh,
I
no,
kind of
no,
got
that's
sidetracked there.
perfect. I mean, typically we're not going to know about some of these accounts till we pull a credit report. So then,
Yeah.
then we're in that position. I know when I've talked to Jim about this in the past, he's a big fan of what they call recent activity. So
Mhm.
if let's say it's an old charge off or old something and hasn't reported to the bureau in 5, 6 years, somebody pays it off. The reporting date updates, the balance goes to zero, but the reporting date updates. That's something where I'll call Jim and say, hey, how much of an impact is this going to have, better or worse? In some cases, it could be worse because it pulls that charge off at recent activity to the front instead of back in the review mirror. So definitely something we work with Jim. I'll have Tony put Jim's contact information into the chat too. But Tracy asks, oh, and actually, Jim just responded to my question. A borrower cannot do their own rapid rescore because that does have to go through the mortgage lender because it ends up on their tri-merge report, which after I thought about it, made more sense. So, all right. Tracy asks, are you able to eliminate a payment? This is a great question. So this is an installment loan is what she's talking about. So we'll think car loan, student loan. Are you able, Kim, to eliminate a payment from their debts if there's 10 or less payments left on conventional or FHA loans?
Um, so for conventional, yes, if it is an installment loan and it is less than 10 payments, then we can exclude that payment from their qualifying liabilities. For government, the amount has to be 5% or less of their the balance. The remaining balance is not 10 payments or less, but it's 5% or less than their total gross income that we're using to qualify on the loan. Also, there are caveats to both of those for conventional government loans, FHA, USDA, and FHA, VA, FHA, where if it seems to be a burden to the borrower and it affects their ability to repay, that is up to the underwriter to validate. So if you're looking at an $800 payment and the borrower's debt to income ratio is high and they still owe $8,000 to that, and we're going to disregard that even though they owe 10 months on it, that $800 on a $100,000 loan, that could be very detrimental to them if their debt to income ratio is very high. So it is something of it depends answer because we have to make sure that they have the capacity to make their payments and we're not putting them in a bad situation by not including that $800. So the straight answer is yes, 10 or 5% below their gross income. But the caveat is they still have to meet the ability to repay guidelines, which is making sure that the ratios are still going to make sense and that they have the assets to cover whatever they need.
And to be clear, when you say gross income, we're talking gross monthly. So yeah, gross monthly income. So okay. Good, good, good. All right. So that's an excellent question. Thank you very much, Tracy. And let's see here. All right. Liliana asks, and we somewhat addressed this, but what are the most common reasons files get delayed or kicked back in underwriting, and how can realtors help their clients avoid those reasons?
That's a tough one, right? Um, Most of the time, it is not realtor based. Let's be honest. It is definitely something with the qualifying aspect of why loans get kicked back. Whether they have a credit event, a serious credit event that has just recently occurred, a foreclosure or a recent bankruptcy, and they're trying to get into a loan that doesn't allow those, That's a major thing. What we are seeing a lot of now is a lot of borrowers will tell our loan officers and maybe realtors that they make a certain amount, because that's what they feel that they make. When you get the actual documentation and you see what they've made over the last 9 months, it's not solidified. It's not an actual average. So we look at income in the past to review for the future, right? So the stability of the past makes us feel comfortable that you're going to be getting this in the future. If you have a borrower that, if I just started a job at CrossCountry this month and now I'm making $50,000, but prior to that I was making $10,000 a year, that's something that is a huge risk because of the huge gap. So usually we look at averaging, we look at the past years. That's another thing that's happening is a lot of people feel that they're making a salary when they're paid hourly. And a lot of companies since COVID are cutting back hours, and borrowers may realize it, but some of them may not, and not realize that that is impacting their income as well. What other things are you seeing, Rich?
No, no, that's good. I mean, those as far as getting kicked back or delayed, usually, I mean, the income is for sure an issue, but hopefully the processors are vetting a little bit of that before it gets to an underwriter. But there's definitely interpretations. I think sometimes there's debt that's found in a bank statement that, or questions in the bank statement would probably be a little bit more common, like they get a bank statement and they see a regular payment coming out that isn't on the credit report. Okay, what is this company? And you mentioned a firm, but there's obviously even child support. Somebody might have neglected to mention that they had some sort of support or alimony payment, but yet you see the deduction every month on their checking account. It's like, okay, wait, we have to account that and get that into the mix. So those are probably the more common things. But I think if you've got a good loan officer and a good processor, when that file gets to underwriting, they should be pretty happy with that, and we shouldn't be getting too much kickback. So that's our processing team's goal at least. All right, Kim. Denise asks, who can remove PMI if it can be removed?
Uh, After close, I'm assuming that's what we're talking about. So borrowers definitely need to reach out to their servicer of their loan once they feel that they've hit 78% LTV on their equity. They need to reach out, and then the servicer will then do their own evaluation of value and make sure that it is below that 78 and that they can take off that PMI.
There's probably from a conventional loan, you're looking at a couple different options. Number one would be just the natural amortization of the loan. So clients are paying, maybe they paid it up a little bit. So just for round numbers, they bought the home for 100,000. They put down 10%. Over the last 2 years, they've prepaid it down to about 78,000. Then go back to the lender. If the lender hasn't already taken it off and say, hey, lender, I'm at 78,000. I paid 100. You don't even have to appraise this property. I'm at 78 of the original purchase price. Let's go ahead and get that removed. Now, the next level would be, well, I bought it for 100. I put down 10%, but now I put a $50,000 addition on my own cash into the property. So the property's gone up in value. I'd like to go back to the lender and say, hey, do me a favor, appraise this based on the improvements that I made, because I feel my house is worth a lot more than the 100 I paid for it. And then you can get the PMI drop there. The one place, and of course, the PMI stands for private mortgage insurance. When we talk about government, that's just mortgage insurance, not private. And that unfortunately doesn't go anywhere. So they don't care about your loan to value, you just have to refinance. All right. Jeanette's got a long one here, but I think this is a couple parter here.
Yep.
Let's see. Oh, this sounds like one of those, hey, this might have happened to me questions.
Yes.
Yes. All right. So we'll read the whole thing out here. So, for which applications are lenders required to send property disclosures and underwriting? We talked about that a little bit. If a lender accidentally sends them over, could that hinder the process or affect the sale in any way? Context. So here we go. This is a real live example from Jeanette. A colleague mentioned something to me about a week ago. She was under contract and out of attorney inspection period. Her clients went through the inspection, agreed to proceed with the home as is. Since they plan to do renovations after the closing using the proceeds from the sale of their California property, long story short, it seems the lender may have sent the property disclosures on the conventional loan when it might not have been necessary. We kind of addressed that. If they don't send them, don't send them. But you may be in a situation where you have no choice. There are some institutions out there. The only one I'm aware of, I'm not, and there's probably more, but the only one I'm aware of is Chase does ask. They ask for that seller's disclosure. So, and I think even if we sell loans to Chase, they ask for that seller's disclosure.
Yes,
So,
they do.
so we know that to be a fact. As long as you're not dealing with them, you should be able to convince your lender not to send it. Once they send it, that's Kim, do you want to talk about things that can't be unseen?
I will tell you, it is very hard, right? There are things that come over that we are like, ooh, we did not want to see that in underwriting. Once it hits an underwriter's desk, though, it can't be unseen. That's the hard part. That's why we have that additional layer of the processors and the great processors that Rich works with, because they look at every documentation, every document that comes in for underwriting to look at, so that they evaluate if there's an additional condition or, oh gosh, we don't want this. How else can we document this? So it is very hard. If there is something that is a little bit on the gray area, those are those escalations that come across my desk. And then I make the determination on, will this make or break our loan? Or can we go ahead and proceed a different way?
Yeah, in Regina, I think we covered your question. Definitely if they've renovated that property and added more value. But I want to go back to Angela's question. This is going to be a pivot from the PMI conversation. And she did the second part. We already talked about the FHA does not go away. And we were talking about conventional only. But her question, and I definitely want to hear Kim's explanation on this one. So for conventional lending, do you need 7 years after a foreclosure and then to get a new conventional loan? And is it 7 years based on the release of the sale of the home, the sheriff's sale, or what's the date that they're using for that 7 year window? I'll let you opine on that, Kim.
Sure. So um, foreclosures go off of the date that the sheriff's deed or your sheriff's warranty deed comes through, that it's executed, not the date that it was recorded, not the date that it went from notice to sale, not the notice of intent. It is actually that sheriff's deed of when it was dated and executed. That's the date that we start the seasoning off of that. You are correct that it is 7 years for conventional loans. However, I do want to talk about something that's called extenuating circumstances. And this is probably getting a little bit more into the lending aspect, and you may or may not be involved in, but extenuating circumstances are big in the lending industry, in lending guidelines. If you have an extenuating circumstances, then we look more favorably on seasoning issues, i.e. bankruptcies or foreclosures, or derogatories on your credit. So what is an extenuating circumstance? An extenuating circumstance is where it's something that has occurred to the borrower that they had no control over and that will typically not happen again. So a loss of a job. Some agencies will allow you to look at divorce, which means a loss of income again. So those are the major things. If there was a medical issue or something of that nature that is an extenuating circumstance, not out of your normal, that is out of your normal life, then we look at those to see if we can make a case as to why we can allow something that is more favorable on those seasoning requirements. So for conventional, you can't, I'm sorry, Rich, for conventional, you can go 4 years from a foreclosure if you have an extenuating and a documented extenuating circumstance. Before we start getting into the HIPAA stuff, as underwriters and as I guide all of my underwriters, we do not want medical records in a file, right? We definitely don't. But where it will come into play, right, is if they have medical bills, if they have medical collections, and we document that all of that kind of flows together, then that's where we look at those. The same thing for FHA. FHA for foreclosure, you have that right on the money. But for bankruptcies for foreclosures. If you have a borrower who is currently in a bankruptcy 13, we can do those for FHA as long as they have a payment history for the last 12 months that's paid as agreed. And we have a letter from the bankruptcy trustee stating that they are allowed to make this loan. Those are the major things. If it's been discharged within the last year, we can definitely still do the FHA loans. You don't need then that payment history and you don't need that letter from the trustee. But it is a manual downgrade, which just means that our DTIs are a little bit shorter and we look more at the full credit breadth and they have to have some reserves. So there are options agency wise to help out borrowers who have had that one whoopsie or that one extenuating circumstance that we can help them through to get them to home ownership.
And we have a chart that we'll send out that kind of talks about what the waiting periods are based on events. But to kind of surmise what Kim had said, 7 years if we have what we call the dirty word in our business for this kind of stuff is financial mismanagement. So if it's truly just financial mismanagement and there wasn't anything that came into their life, unusual job loss, divorce, medical, that created that situation, then yes, you're 7 years out on a foreclosure. It's 4 years out with the extenuating circumstance. And then, Kim, do you want to talk about foreclosure slash bank simultaneous bankruptcy?
Yes, so for I closed my comments, so I'm gonna have to figure out how to get that back in my chat. So I'm sorry.
That's
Um
okay.
so with Fannie Mae, um or agency conventional loans, if you have a bankruptcy that includes a foreclosure in it and they've actually lost the home in that bankruptcy, we can go off of the bankruptcy guidelines as opposed to the foreclosure guidelines. So that is a little bit of a cushion that allows people who have really had some major issues that we're just trying to get over, as opposed to waiting that full 7 years for that foreclosure. We can definitely look at the bankruptcy seasoning.
Bankruptcy seasoning is so for
Sure.
that for 4 years. Okay, good. So on the and then just to go back to I want to talk about yes, we do lend to folks that are in a chapter 13. The way the Illinois the courts and the trustee changed how we handle that going forward. We used to get the judge's permission before going to contract. Now they won't even give us permission until they're under contract. So if you're going to come to us, get somebody pre-approved that's doing that's in the middle of a chapter 13 that qualifies, then make sure you write your contract. I'd say for about 35 days. It doesn't take too long for our buyers to get into the courts and get that approval, but they cannot get that approval until they're under contract. So the bottom line is it's not a quick close. However, any client I've sent to go do that traditionally comes back to me within 7 days with documentation they need. So it is pretty quick to do. All right. There was a question I want to make sure we did. Oh, there it is. So Lydia asked, she wasn't sure if it's a question for underwriting, but do we verify zoning? Typically, zoning is actually verified by the appraiser. So the appraiser, that's or the underwriters are getting all of their data from the appraiser. The appraiser is making sure the property is zoned. Their responsibility is to let the appraiser know that the zoning is for a home and not for anything else. All right, let's see here. Can we remove the escrow in a conventional loan and request this? This is kind of Regina asks an interesting question that I want to circle back with. So we talked about having escrows required. So can we remove an escrow on a conventional loan? Actually, so when we talk about escrows, we're talking about real estate taxes and homeowners insurance. Now, traditionally, as long as I've been in the industry, which is closing on 40 years, anyway, closing on 40 years, as long as I've been in the business, if you weren't putting 20% down on a conventional loan, you were putting your taxes and insurance into the mortgage payment. However, Fannie Mae and Freddie Mac does not require that. Excuse me, the underwriters are allowed to approve a loan closing at a loan to value higher than 80 loan to value and have the buyer responsible for their own taxes and insurance. Kim, do you want to talk about why you would approve something like that?
I definitely would approve something like that if we show that the borrower has assets to cover. If they have a lower debt to income ratio, if they have experience of paying their taxes and insurance in the past. Um, to be honest with you, I rarely do not let those go through. We do ask personally at closing that we have a hold harmless and that they know that they're paying those taxes and insurance, because we would hate for a borrower to lose a house to foreclosure when they don't realize that they need to be paying their real estate taxes. Um, the only ones that we cannot waive are FHA and USDA. So any USDA loan and any FHA loan, they have to have their taxes and insurance escrowed in with their payment. And we do allow it for VA. At that point, that's when I definitely do take a little bit of a closer look at that to make sure that we're not putting a veteran in a situation where we don't feel like they could handle or making those payments, and also need them to validate at closing that they understand that they are responsible for these payments.
As a follow-up to that, Kim, Regina asked before we get off topic on this different topic. She said, "What about removing them after closing?" And it's a servicing question, so I always kind of step aside. Like I'm not sure what servicing's position is on that, but I don't think it's really successful from what I've seen. You think the same thing, yeah?
I
Okay.
think the same thing. I feel like, to be honest, a servicer is always open to talking to borrowers for a reason, to fix something for them or to make something a little bit easier for them. Um, I have seen where if they are renegotiating terms of the loan and they want to take out their escrows, that they've allowed it. But just a request to ask for their taxes and insurance not to be included, typically no, because the loan is sold that way for a purpose and probably even sold at a price because of the escrows. So I have not seen anything that has allowed that, but I haven't seen everything, even though I am old as dirt. So
Well, I know I've had clients go, but the law says I can pay my own escrows when I get to a certain point. So sometimes I think they literally have to go cite that law to the
yes.
servicer, but the servicers are not readily giving up that escrow money, unfortunately. We got two great questions coming up. So one we had that was pre-submitted, but I want to get to Maya's question because it's really, really, this is a big deal right now. So you guys definitely want to listen to this one. But and I'm curious if Kim's position based on a chart that I wish I would have copied from our regional meeting today. But the amount of student loan delinquencies right now is off the chart. And it's off the chart because these payments basically became due this year, and most people either just didn't realize that, oh, yeah, we are actually going to pay it, or maybe they were coming due and didn't get their notifications, or they thought, oh, that's just my notice that it's in forbearance. I'll just throw it in the drawer, or I'll just shred it, whatever it is. But the delinquency's off the chart. So to that end, Maya asked, with the current student loan issues, which I just discussed, high delinquencies that have occurred where payments are showing past due on their reports and borrowers weren't notified, is this an automatic denial for borrowers, or if the documents to show that there is an error and that their report has been updated, will they be able to move forward?
That is a loaded question for sure, Maya. I appreciate you touching on it because it is such a major thing at this particular moment. Being someone who has student loans for their children, this has been a very confusing time, right? Where all of the federal servicers have been trying to make sure that everybody's aware that now they need to make a payment and their payment is huge. Or if you want, you can lower your payment. Or if you want, you can let us know that you don't make enough money to make this payment. So there's all of these options. And then heaven forbid that they're like, we don't have that option anymore once you get in it. So I know that there's a lot of confusion, especially for the borrowers. Unfortunately, it is black and white, right? It comes down to definitely what the guidelines are. The guidelines are is this there, if there is nothing showing on their credit report, we hit them with a percentage of the balance. If it shows that there is a zero payment due, if they're showing that a payment is due, then that's what we hit them for. Or if we are able to get one of the IBRs, which I don't think that's what they're called anymore, the income-based repayment plans, but I think they're called something different. If we're able to get those, then that's what we go off of for those. If it is delinquent, that delinquency will be taken into account. If it is incorrect and we have evidence that it is not a delinquency, then that's something that we tell you to go back to the credit reporting agency with so that they can update. But for the basis, if it's included, if the delinquency is included in their credit score, then that is what the credit score is, right? So that goes to say with anything that is erroneous on a credit report. If we have something that backs up that the credit report is erroneous, we can't override any of the credit scores or the credit score requirements. So if there is a credit score requirement and the reason for the credit score not meeting that requirement is based off of whatever derogatory that is incorrect on the credit report, that needs to be resolved from the credit reporting agency. If there is something regarding a payment or something that we can look at to modify of what an actual payment is that goes off of, that is different than what's on the credit report, we'll look at that documentation all day long.
That's I mean, that's the best we can do, unfortunately. But I am going to share a slide with you guys. This was actually, so for those of you who are watching, you will appreciate this. So this is our, can't see, hang on, there we go. Household debt slash delinquency. So this is just talks about effective the second quarter, which is crazy because we're actually already through the third quarter. But for those of you who can see this chart, this straight orange line that's going up, that's student loans. So that is your student loan delinquency that was probably around 1% that is now north of 10% at the end of the second quarter. So I mean that's how serious this situation is with these student loans, unfortunately. So yeah, that's pretty mind-blowing from a chart standpoint. But all right. Yes, Regina, there's a lot of errors, so get us the information so we can get them fixed, and we'll work with your clients on that. Lloyd asks, what should a potential buyer do when they have a lower score like a 540 when seeking to purchase a home? You want me to handle that, Kim?
Yeah.
Okay. So typically what we see when we start seeing these lower credit scores is not only is there a lower credit score, but sometimes there's a need for down payment assistance. And that can be problematic because in the state of Illinois, IDA's credit score bar is 620, 640 in there, depending, but you still need to have pretty much close to, for most DPAs, about a 640 score. Now, there are a couple other products that we have that as long as you get north of 600, you can get access to those down payment assistance as far as that's concerned. So what advice do we give somebody with a 540 score? And we talked about it before. Get with a credit professional. The one that we refer, who's in the chat, not only do they do very hands-on comprehensive, but if somebody says, hey, I really just want some guidance and I want to do it myself, Jim's got a way to do that too. They have a place they can send you. They'll give you all the guidance. It's a fraction of what he would charge to take care of it for you, but they'll give you the guidance if people want to manage that and start improving their credit themselves. So specific to getting out of a 540 up to a 640 or even over a 600, that's going to be case by case. But my advice would be to seek a credible credit professional to help get that stuff north of there. All right. Claire asks, what are red flags for underwriters, Kim, and what can realtors do to help their clients avoid those red flags? And
I don't know that there's
we talked about new debt. So,
new
that's a
data.
red flag for an underwriter is any new debt, which we try to do our best to tell people, please don't open up new debt from the time I pre-approve you until you close. And if you do, come call us. I have a story that I'll tell, Kim, and I'll let you handle this,
You,
but I had a young lady that we had pre-approved and she was in the middle of her contract, she's about 2 weeks into a 4-week close, gets in a bad car accident on 290. Those of you who are local, you'll know where that's at. I get a hysterical phone call from her at rush hour. You could hear the traffic kind of buzzing around her. And I'm like, oh my gosh, are you okay? She's like, I just got in an accident. I'm like, Did you call an ambulance? Are you okay? She's like, I'm gonna my car is totaled. She was trembling and crying. She goes, I'm gonna need a new car. I need to know if I'm gonna be able to still buy my house. So it was really, really sad. She was able to still buy her house and she was okay. But she was very concerned as I would hope most of our buyers would be. But unfortunately, they do screw up and they go out and get new cars and new debts and yeah. So Kim, what what do you advise?
Well, I don't know that there's any red flags and really into like figuring out when realtor meets and is really speaking to borrowers on what they do. A lot of things that hold us up that tend to be red flags are borrowers who don't want to tell us that they're self-employed. Or borrowers that don't want to tell us where the cash is coming from for their down payment. Those are probably just some red flags that could be like, we need to really drill down. I don't want to get into their personal life or specifics. We get into enough of their personal life by getting their bank statements. And I know that that's very, it's very violating, I'm sure. But, we want what we want and we don't want to get into anything else for it. So for red flags, I think the main thing is just always tell the borrowers and your buyers to be absolutely blunt and honest and open with their loan officers, because the loan officers then can either work out a way to get it done or tell them how to overcome whatever issue is holding them back.
That's perfect. That's perfect. So we got two more that I want to cover. Then we're going to get into our couple offers that we have for you guys, including a presentation we have coming up next week, which should help you get some more business. Kind of a last minute presentation, plus it ties into a book release. So I'm really excited about that. But we've got two more questions that I want to cover. I know you did some research on this one, Kim, so I'm going to jump ahead to this and work my way back to the insurance. But
All right.
Mark asked, Mark's always got great questions in the meetings I'm at with him. What's up with hybrid appraisals?
Oh my goodness. Well, Mark, you did a number. You stumped me with this question because I was like, what is a hybrid appraisal? And my guess is some other lender is probably using that term as well. So for everybody else who is maybe as not set as I am on this question, hybrid appraisal then really goes into the shorter version of the appraisals, right? The drive-bys, the streamlines, those fun things. Um, right now, based off of what we are seeing, about 99% of our loans need who that require an appraisal, we get a full appraisal. There are certain times where we can use a drive-by appraisal or something that's small, but not on a purchase and definitely not on most of our agency products. The other times that we can use those hybrid appraisals or the smaller appraisals or the streamline appraisals or the, drive-bys is when you have an FHA appraisal and we need to validate what a rents would be or what a value is so that we can calculate equity off of another real estate property owned, not the subject property. I will touch base on this as well, which Mark, hopefully there are areas in the United States that have some extreme growth and extreme equity in some homes. So there are programs out there and it is specified by the automated underwriting systems when you don't need an appraisal, when they've already validated what the appraisal is, what the value is, and they say, you're good to go. We don't need an appraisal. That saves everybody a ton of money. And we love that. So that's something that Rich and his processing team take a look at the second that they get a loan in to make sure that the LTV, the loan to value meets, and that the transaction type is correct for it and that our address matches so that we can see if we can get that appraisal waiver, because that is an option on all of conventional loans based off of if it is a purchase, what your LTV is, and where the location of the MSA is.
Perfect. Perfect. All right. Jack asks, and my understanding is Jack's asking for his own personal reasons. I think Jack's an insurance agent, but these are great questions. I love this. Um, Kim, what are the biggest red flags you see in homeowners insurance policies that can hold up a loan? And by the way, this is part one of about four questions he has, but what are the biggest red flags you get a policy and what are you concerned about?
Well, insurance is another big topic, right? We are all in this weird lending realm at this moment with student loans and with people and they're thinking that their salary and they're not their income. But the other biggest problem that we've had, and Rich can really attest to this even in the last 4 months, is insurance. Where we look at agency requirements, and this is Fannie and Freddie requirements, really need a replacement cost estimator. And that is something that we in the lending industry really haven't been attuned to or really fixed on for a while. But uh, getting insurance costs down is really important, right? I think that we want to make sure that our borrowers are covered and that they can afford their insurance. And what has happened is we used to, if you remember, ask for insurance that covers the loan amount. That's not a thing anymore. We don't do that. The other thing was, well, what does the appraiser say that the replacement cost is? We don't use that anymore either. We don't look at appraisals. Um, we want the insurance company to tell us, what is your replacement cost on this home? And number two, are we covered? Again, collateral is the basis for all of our loans. We want to make sure that our collateral is good. And number two, that our collateral is insured. And we want to make sure that it's insured so that if we need to rebuild or the borrowers need to rebuild, or we are able to at the cost of whatever market is at that time. So my suggestion to everybody who is doing a loan or telling a borrower to do a loan is make sure that your insurance provider provides that replacement cost estimator. If they do not have a replacement cost estimator or they don't want to provide that to us, then we ask that they have guaranteed replacement cost. And that is a huge umbrella that covers everything. So guaranteed replacement cost would be whatever the cost is of the property, we're going to guarantee that we're going to replace that at that point. All of these are, big factors that have come up because for the longest time, everybody, including underwriters, have just done the knee-jerk reaction of, okay, well, our coverage covers our loan amount. That's not enough anymore, especially when you're doing a lower loan to value loan amount. We don't have enough covered then to replace that property. Those are the biggest red flags that we see. The other thing is that a lot of times in Florida, I know that we're mostly all in Illinois, but a lot of times in Florida, we've seen uh, some policies that have come over without wind and hail coverage. Wind and hail coverage is what we need. So to reduce the cost of however much their insurance is, they've opted out of wind and hail, wind and any kind of coverage that is actually definitely needed by our agencies. That's the number one red flag. If you're doing a primary residence, I'm just going to tell you another red flag real quick. If you're doing a primary residence and you have a insurance policy that comes over with rental coverage, that's a red flag to underwriting, because then we know that the borrower is trying to get rental coverage for a home that they say they're going to live in.
That's for sure. I think you probably covered some of the other questions that Jack had to follow up. There's one in here that I think I know the answer to this, but do you have a preference with working with certain carriers and why? Is there anything that, yeah, I wouldn't like insurance?
No, I mean, the smaller agencies, right, and the brokers, they tend to not understand exactly what we're looking for when we're asking for a replacement cost estimator. And when we ask them, does this cover debris removal? It's like pulling teeth to get them to write something else. At CrossCountry, we have adopted where we will accept emails from the insurers so that they don't have to wait for an insurance underwriter to redo the policy or the binder for us. So that's an allowance that we've given to them as well.
Awesome. Yeah, and one thing that we're doing a little bit differently from an insurance perspective, so for our agents should know this, if you, the agent, haven't come to me and say, hey, I have a preferred insurance provider that I'd like to use, we're asking the borrower if it's okay for us to send a limited amount of information out to a handful of carriers. Those bids come back to me. We forward them to the client, and the client chooses who they want to do business with. Ultimately, the reason we've done that is because we'll be humming along, everything's fine, and this happened to us last year. We had a nurse buying a 3 flat on the north side, humming along, and all of a sudden we get a premium at 5,800. We didn't qualify for a premium at 5,800. We were closer to like 2,400. Now we ended up getting it down to 28. She qualified, but guess what? She doesn't get the house at 5,800. She does not qualify with insurance that's twice where we started. So we're going to be proactive in that regard. It's something I learned from our friend Laura Locke, who I think Kim may know, but Laura's a friend of mine and a manager out in Los Angeles, and they've been doing that for a while because insurance is very limited there in Los Angeles, unfortunately. So we're doing that, and we are out of questions, and we're on to our next thing. If you guys have any other questions, pop them in the chat. Otherwise, we have a last second, if you will. This is not a lunch and learn, but it's going to be around the same time. Thursday, October 3rd, from 12 o'clock to 1 o'clock, we have a free class for you guys on proven strategies that will generate return on investment, referrals, real live examples from agents. We have an agent here in this market who lives on postcard mailings, and she has a book coming out. I want to say October 28th. And she's got a book coming out. You guys will have early access to the book if you go ahead and attend that. She's going to talk to you about how to basically make a solid living doing mailings, and you guys will actually have access to the free copy of chapter 1 courtesy of us, and then obviously early access to the book. And she basically says why you should attend. It's not another marketing webinar. You're going to walk away with actionable steps to strengthen your 2026 pipeline and position yourself as an agent people remember, recommend, and return to. Tony's put a link in the chat. We'll obviously start marketing that. It's something that, I've got a chance to talk to the author. We're really excited to have her in here. I know what her business model is. I know how well she does. So please sign up for that. In the meantime, for those of you on this call who haven't used the Kimball team, we're offering you a limited. You send us an opportunity between now and Friday at noon. We will give that opportunity $500 off at closing if we close that opportunity by the end of the year. So we want to incentive you guys to give us a shot. We've got a great team here, and we would love to service you guys. Let's see, did I have another question? Oh, got some thanks. Love that. Lori, thank you so much for being here with the PSA relative to what's going on with our mechanicals. I think that's hugely important. You guys, please reach out to Lori as a reason to get back to your client database. Get them this information. Kim, I know you're a little short-handed today, so I could not be thankful enough. I really appreciate you. We're mailing you the clock on Tony's wall. I don't know how we're going to do it because it's digital, but we're going to get that to you. So that being said, thank you guys all for attending. And as I always finish this, none of this stuff happens without Tony. Thank you very much, Tony, for taking care of everybody here and everything here. So couldn't do it without you. Thank you guys for attending. Let people know that we're here to help you guys out, help you grow your businesses. And I will see you hopefully next week, October 23rd, 12 o'clock Zoom. No sandwiches, but plenty of paychecks. Bye, guys.
Thank you.
Take care.